All right, guys, so now I want to go ahead and get into the double income dividend strategy. And then that's what I kind of call it myself. Um, but this is all about how to supercharge your passive income. And so let's go ahead and get into this. See if my slideshow will load here. There we go. So, yeah, that's the first thing I want you to understand is the X day. Now, I've talked in other, I made a cash secured put. I forget which one I mentioned this in, but I mentioned the X day before. But let's go over it again. Okay, so the X day is the day that you are no longer entitled to receive the dividend if you purchase a stock. So, if you purchase the stock on the X day, you are not entitled to receive the dividend. However, the second point there, if you buy the stock one day before the X day, you will receive the dividend even if you sell the stock the next day, okay, on the X day. So essentially, a person selling stock on the X day will receive the dividend, but the buyer on the X day will not receive the dividend. So is if you sell, the X day comes around, and each company will announce when this X day is, so you'll know, it'll be before the dividend is actually paid out. So it's different than the actual payment day. But that last point on the list, thus, one business day before the X day is the cutoff for buyers of the stock to purchase and still receive the upcoming dividend. And just to, get this in your head, the seller on the X day can sell, right? And they will still receive the dividend. But if they sell the day before, they will not receive the dividend. So that's just important to keep in mind. And then, once you understand the X day, you can kind of, realize the strategy here and what you can accomplish with it. So the first thing you'll need to do is purchase 100 shares of stock. Now, you can do this as part of a combination of the wheel strategy if you want, or you can just outright do it with covered calls. Okay, so that's what we're going to be talking about. But yeah, go ahead and purchase 100 shares of stock. And so once you own the 100 shares, sell a call option that has an expiration day that is at least on the ex-dividend day or further out to expiration. So, on the ex-dividend day or further out to expiration. Now, remember what I said about the seller receiving the dividend, right? You already own the shares, okay? So the seller receives the dividend if they sell on the X day or later. So that's why you want to choose an option or a covered call to sell that's at least on the ex-dividend day or further out to expiration. So the reason for the expiration date of the call option needs to be on the ex-dividend day or further out is because even if the option goes in the money before expiration, stock above the strike price, the most likely scenario is for it to be auto-exercised on the expiration day if it is in the money. So probabilities in your favor. This is not always true. With American-style options, the buyer of the option technically has the right to exercise that option anytime before expiration. But a lot of times what you see is that they simply close out their positions. And working at TD Ameritrade, I saw this myself. Most people who call in, they don't actually want to exercise that option because they have to put up the collateral to purchase the stock and stuff like that. They would much rather just close out or sell to close that options position. Now, on expiration day, what happens is the OCC, or the Options Clearing Corporation, if that option is 1 cent in the money, it will be auto-exercised. So the buyer of a call option in that case, even if they don't have the capital in their account, they'll be in a margin call. A lot of times is how brokers do it. So that's how TD Ameritrade would do it. You would see sometimes some weird stuff with options expiration. Somebody forgot an option was in the money. It exercises automatically, and then, they get a margin call saying, hey, you need to purchase these shares, right? Even if they don't have the money in their account. And a lot of times brokers will try to close out those positions if that's the case before it actually expires. But nonetheless, that is something you see. And so you're the seller of the option, right? So keeping this in mind, the probabilities are in your favor. And this is not always the case because, like I said, with American-style options, the buyer of the option can technically exercise it before the expiration day. But, excuse me, it all comes down to probabilities, like I said, because at the end, you're guaranteed if you were short that option, if you sold that covered call and that's in the money, those shares will be called away on the expiration day. Or typically it's over the weekend, right? But the probability is that you're going to get to keep your shares until the expiration day. So therefore, you still receive the dividend in your account, and of course, you still collect the premium no matter what happens from selling the option. So it's random, right? When they choose this, the options clearing corporation before expiration, if somebody wants to exercise, it's just a random contract that's chosen. But since most options contracts aren't actually exercised before the expiration day, this is kind of your opportunity, right? So we're selling that covered call, right, with that expiration day on or further out to expiration. Since we still own the shares in our account, right, they have not been called away yet, then we still receive the dividend. And so even if that option's in the money, we keep the premium, right, no matter what. And so that's basically how it works. Get the dividend and the options premium. So give you an example of this strategy and how it can work. You purchase 100 shares of XYZ stock at $50 per share. Then you immediately sell a covered call against it for $500 in premium at a $55 strike with an expiration day of Friday, October 7th. XYZ stock has its ex-dividend day on Friday, October 7th as well. Since the expiration day of the stock and the ex-dividend day fall on the same day, you are likely to receive the dividend and the options premium if you simply hold the option until expiration instead of closing it out, right? So you're selling to open when you're selling a covered call. You could buy to close that position. But if the option's in the money, why would you do that, right? Even if your shares do end up getting called away, and it's possible it could happen before the expiration day. That's always a possibility. But what's the most likely scenario? Probably that you're going to get to keep your options contract before or until the expiration date. Not always, but a lot of times that's what you'll see. And so you simply let it expire. If your shares get called away at that point, you still receive the dividend. And that's regardless of whether the option is in or out of the money. So hope that makes sense. And let's go ahead and TD Ameritrade. Let's go on over there and see some live examples here, and then we'll come back to this page. So let me log into my account, and we can go over to Thinkorswim too. Actually, let's go ahead and go over to Thinkorswim and take a look here. So just to show you some examples, let's find a stock that's paying a dividend actually first, and we'll see when the next dividend for Procter & Gamble is. So, let's see, dividend. So PG dividend history. See that there is, let me load this here. Hopefully it loads for me. Computer's going slow right now. There it is. Come on. Come on now. Come on, Procter & Gamble. Let's go. I'm going to put this on pause and come right back. All right, guys. So I came back and I found the page for Procter & Gamble. Now, it looks like here they actually have not announced the next dividend based upon what I'm seeing on their investor relations page. But you'll see here that the last dividend was on 7/21, and they do pay pretty consistently, or that was the X day, I'm sorry. So the actual payment day was over here, but this is what you want to focus on. So if we assume the X day is every 3 months, you'll see that it typically occurs around the 20th through the 22nd. Okay, so we can expect that, July, right? So we go August, September, October. So that next X dividend day is most likely going to be around October 21st. We're just going to say around then. We then come over to the options chain for Procter & Gamble. And, I kind of want to take a look at the chart too and see how it's been doing because, I want to kind of show you like what we can maybe expect for Procter & Gamble. What are we looking at here? I mean, the stock is down, right? So are we really expecting Procter & Gamble to make a move, up to 150? It's possible, right? And that would be over the next few months here. So what you could do is, sell, if you're bearish on the market and you think things are going to stay down, right? The market's in turmoil right now anyway. So, let's say you already own the shares and you're looking at, let's say like the 150 level or 145 or 150 level. You're like, I don't know if that's going to, hit or not. You're thinking that it's going to stay down. Let's take a look at the options and you'll see that 21st of October. Now, this is kind of, you could go out an additional week to play it safe because, depending on when that X day is, that can get a little bit tricky in terms of if you're going to receive the dividend. It could be on the 22nd well, your shares would be, sold out by then. It's right there, right? What if it's late this time, the 22nd, or it could be early, but we don't know for sure when that dividend is going to be paid. So to be safe, you could go out an extra week to the 28th. And when I say paid, what I really mean is the X day. I'm sorry. So, look at the 28th of October expiration. And I was kind of eyeing like the 145 level, the 150 level. Kind of thought that would be a good level to sell the option, right, against. And so let's take a look at, for 150, you're not going to get a good amount there. $56 per contract, not a huge amount. But the 145 level I really do like. And if we look at the chart on Thinkorswim, you'll see that we could easily test that level. For the 150 level, it really comes down to like how much options premium you want and, the risk that it does go in the money before expiration. And then, of course, the probability, it's based upon random, exercision, right? The Options Clearing Corporation will choose a random options contract at that point if it does go in the money. So, if you wanted to do the 150 strike, you could. That's kind of a level of resistance. 145, though, I'm going to go ahead and go for. And we're just going to, hope that Procter & Gamble doesn't go in the money. And if it does go in the money, that, we're not called away our shares before expiration. So let's take a look here. We're going to say we own 100 shares. So it defaults to 10, but let's go ahead and, let me fix this here. So one contract, sell to open, and that's the wrong, actually, let me find the October 28th is what I'm looking at. So it's going to be a couple months out here, and 145 is, looks like $146 for the contract there. So you'll see that our max profit is 14. Oh, it's defaulting to 10 contracts. I want one contract, but you get the idea. So, that our max profit there is $146 for selling the option. That's ours no matter what. Now you'll see the max loss is infinite, but if you already own the shares, then your max loss, technically if Procter & Gamble went bankrupt, would be infinite less the premium. But, nonetheless, you're not going to have to worry about this. This is in the case of a naked option. If you sold this without owning the shares, but nonetheless, that's another story altogether. You're doing a covered call, so you're getting $146 for selling that option. Now let's take a look. If we look at the past dividend history, you'll see that, they've been raising their dividend quite consistently. They're paying 91 cents per share. And so now we can factor in like how much we can make from not only the dividend, but also if you're looking at the premium that we're getting. So times 100.9133 is the dividend. $91.33. And then the options premium is $146. And the stock, since we bought it, of course, we just bought the shares, we'll assume at $138.28, so, or we'll just say $138 to make it easy. The strike is at $145, so you take 7 times 100 shares, that's still $700 in upside. So you have the dividend, you have the options premium, and you still have the strike price factored in. Assuming we receive all of that and things work out in our favor here, we receive double the income, and we also get the share price appreciation, of course, up to the strike price where our shares will be called away at that 145 level. But not to fear, right? Because we can always turn around and sell a put against it after that if we want to and do what's called the wheel strategy. So that's just an example of how this can work. I'll head over to the website and show you an example on tdameritrade.com because I know a lot of people don't use these like more advanced trading softwares like Thinkorswim. I think it's pretty helpful, going over it in Thinkorswim, but let's also go over it in the website here, just so, because if you're just doing it on like your broker's website, this will be how it's done. It'll be different than, TD Ameritrade, obviously. Depending on which broker you're using, it'll be a little bit different format, but it'll altogether be pretty similar. All right, so coming back here to Procter & Gamble, got logged into my account and everything, and now we're taking a look at the quote. You type it in, the underlying symbol. I have single order marked for the option strategy. Action is going to be sell to open since we're selling this covered call. We're going to do one contract since we own, let's say, just 100 shares. Expiration, we're going to go for the October 28th expiration. The strike price, let's go ahead and select the strike price of 145, and then we'll select call/put. Well, not put. We want to do a call, and you'll see that the options premium is 146. So So we'll put $1.46 in there times 100 will be $146, not including commissions. So, TD Ameritrade charges 65 cents per options contract. So this is not going to be much. Like if I go to review order, you'll see that minus the commission, my options commissions are a little bit lower because I was, when I worked for TD Ameritrade, I got grandfathered into, the lower rate and everything. But just gives you an idea. So most brokers are going to have pretty low options commissions. If you're paying like $5 or something crazy, for one options contract, you need to find another broker. You shouldn't really be paying more than $1. 65 cents for really, I would say under that is what you should be shooting for or around there, because you can find brokers who, are not going to charge you much. I think Robinhood might still be free for options. I don't believe they're the best broker because they don't have really good customer service, but you'll see the commission is factored in, and then the net credit will be 145.48 for this trade. So nonetheless, pretty simple strategy. You're basically what you're hoping this, when you sell this, right? You're hoping first of all that Procter & Gamble doesn't really go above 145 because then there's zero chance that anybody's going to exercise this option, right? Now technically they could. There is still the chance that somebody would exercise the option, but they're not going to unless they're absolutely crazy or they're not thinking straight. If the stock's under 145, why would they exercise that option? Now once it gets above 145, you still have a couple months until expiration, so then it's kind of a roll of the dice. But like I said, probabilities being in your favor, most of the time what you're going to see is that people will just close out the options. They'll buy to or sell to close. Because if they're long a call, what they're doing is they're selling to close, right? They buy to open and they sell to close. So a lot of those options contracts will not even be exercised. Now you will have some that are exercised if they're in the money. And when that happens, right, then it comes down to a random process. It's like, they spin the wheel, and if your number's picked, then you have to sell your shares before the expiration day. But of course, probabilities being in our favor, we're hoping that's not the case. And even if it does go above the 145 strike before expiration, we're hoping that we can still receive that next dividend, which is expected to come in on October 21st. So, or that would be the X day, and then the payment day will, we can expect sometime in November. So, July 21st, August 21st, September, and then October. That's 3 months, as you'll see the schedule. If we just assume that everything else remains the same, then that's going to be the case there for Procter & Gamble. And so we're just hoping that, the stock does stay under 145, but even if it does, we're still hoping we can collect that dividend by selling an expiration that is beyond when that X day is, right? So we can still have our shares and then still receive that dividend no matter what. And so that's what I call the double income strategy. And, just going back here to the summary of everything, the strategy can, work great against stocks that you already own in your portfolio and want to receive additional passive income in the form of options premiums. So since dividend stocks tend to be lower volatility, there's less risk that the stock will take a huge move in the wrong direction and not allow you to implement the strategy effectively. So ideally, looking for dividend stocks that have betas of less than 1 or even 0.75 can help this strategy work most effectively and put the odds in your favor for a consistent rate of return in passive income. So the main risk with this strategy, as typical with any option strategy, is that the stock makes a big move in the direction we don't want. So in this case, the stock price, I don't know why I put the stock price falls. So let's see here. Yeah, you know what? I meant to put, in this case, like in the case of a covered call, the stock makes a big move to the upside. Now, of course, the risk is also like the stock falls because nobody wants their stock to fall, right? But in this case, specifically, if the stock makes a big move to the upside, is what I meant to put there, then, of course, the risk is that the option could be exercised early because with American-style options, and I should probably make a different lesson on the American-style options versus European-style options, but as I was saying, and I kept on emphasizing, with American-style options, technically the buyer of that option can exercise any time before expiration. But are they likely to do so? That's the question, right? So probabilities being in your favor, we're hoping that the stock, first of all, stays under the strike price before expiration. But if it doesn't, we're still hoping that we can get that dividend by selling an expiration that's past the X day. And so we get that double income by doing so. Having said that, guys, I hope you enjoyed this lesson. Let me know if you have any comments or anything. And let's go ahead and get into the next one.